Not protecting your assets is risky. Some time ago, I was one of the keynote speakers at a conference for investors. The main speaker was a very famous television personality who reports on one of the bigger financial television networks. Her talk was informative, and I learned a lot. Yet I found it interesting to hear her say that she only invests in mutual funds. Suddenly, a participant raised his hand and said, "Don't you feel guilty that you were responsible for the billions of dollars your viewers have lost in the stock market?" His tone was angry, and as he spoke, I could sense that many investors were in agreement with him. It seemed that many investors had come to this conference, not to learn about what to invest their money in, but to find out what happened to the money they had lost. "Why should I feel guilty?" she replied. "My job is to give you information, and I do give you a lot of information. I did not give you investment advice. I only gave you market information. Why do you say I should feel guilty?" "Because you were a cheerleader during this bull market boom," said the angry participant. "Because of you, I kept investing and now I've lost everything." "I wasn't cheerleading," she said. "I was just giving you information in a good market, just as I am giving you information in a bad market today." For the next 5 minutes, the anger in the room flared. Some people agreed with the angry participant, and others were taking the side of the female reporter. Finally things calmed down. The television reporter asked for more questions. A hand shot up and asked her, "Why didn't you tell your audience about minimizing their risk with options?" he asked. This participant was not angry. He sounded more curious and wanted to let the audience know that they could minimize their risk exposure by using options. "Options," she said. "Why would I tell them about options?" "As a hedge against loss in a bear market," he said. "Oh, I would never do that," she replied. "Options are too risky." "Any other questions?" she asked, signaling the person who asked about options to sit down. I could not believe what I was hearing. This TV personality is one of the most respected people in financial journalism. She influences millions of people's lives. Many people look to her for investment advice, and now she was saying, options are risky. To me, not protecting your assets is risky. To me, being financially ignorant is risky. Knowing how to use options to protect your paper assets is easy and not that hard to do. In fact, if you have a good stockbroker, the process is pretty easy. A kid could do it. All you have to do is learn the definitions of a few new words, find a good broker, and start small to gain some experience. Instead, I watched many of the 1,000 people in the room nod, agreeing that investing with options is risky. As I sat there, watching her faithful followers nodding with her in agreement that options are risky, my mind drifted back to Rich Dad's earlier lessons on investing in paper assets. I could hear him saying, hundreds of years ago in ancient Japan, Japanese farmers began using options to protect the price of their rice crops. Hundreds of years ago? I asked. Hundreds of years ago they were using options as hedges against loss. Rich Dad nodded, yes, hundreds of years ago. Beginning in the agrarian age, smart businesspeople have been using options to protect their businesses from losses. Smart businesspeople continue to do so today. My mind returned to the room in Chicago where this TV journalist was speaking. I wondered to myself, if smart businesspeople have been using options for years, why is this very influential person misinforming her viewers? I then asked myself, what is more risky, buying a stock or mutual fund and watching it drop 40 to 60%, even to 90% in value, and not protecting yourself? My banker requires me to have insurance on my real estate. Why doesn't the paper asset industry require all investors to buy insurance on their paper assets, assets that millions of people are counting on for their old age? To this day, I do not have an answer to those questions. As stated earlier, if your house burns down, it can be replaced in less than a year and paid for by your insurance company. But if your retirement plan crashes with the stock market after you have retired, what will you do then? Buy, hold, and pray again. Hope for another bull market. So I continue to wonder why bankers require investors to invest with insurance, yet the paper asset industry doesn't. I continue to wonder why professional investors invest with insurance, yet the average investor, who is counting on the stock market for their financial security once their working days are over, invests naked and uncovered. Vocabulary of insurance. If you want to retire young and retire rich, it is important that you invest some time learning how to protect your assets, especially if you plan on holding your wealth in paper assets. You do that by learning and understanding what my rich dad called the language of a sophisticated investor. I call it the vocabulary of insurance. Before getting into those words, I believe it's important to review a few other words. The following are other words that need to be defined before getting into the words of insurance. Investor versus trader. Most people who think they are investors are really traders. Just as most people think their liabilities are assets, many investors are traders rather than investors. One more point. Many people who think they are investors are really savers. That is why most people who have 401k retirement plans, or IRA, KEO plans, often say, "I am saving for retirement." A saver simply puts money into an account and does nothing else. An investor is a person who actively manages his or her own portfolio or account. So what is the difference between an investor and a trader? An investor buys to hold. A trader buys to sell. When a person says, "I bought this stock or piece of real estate because I know the price is going up," I know this person is really a trader. In other words, they are buying only to trade, not to use. That is why I say most people are traders rather than investors. A trader generally wants the price of their asset to move up so they can sell it for a profit. An investor wants the investment to return their money as quickly as possible, all the while holding on to the asset. Rich Dad said, "An investor buys a cow for milk and for calves. A trader buys a cow to slaughter." If you want to be successful in the world of investing, regardless if it is in paper assets, businesses, or real estate, you need to be both an investor and a trader. An investor knows what to analyze and how to manage investments. A trader knows how and when to buy and sell. An investor usually wants cash flow from the asset. The trader wants to realize a capital gain from buying low and selling high. Fundamental investor versus technical investor. A fundamental investor looks at the financial statement of a company or property. A fundamental investor is often concerned with earnings, the management team, and the long-term potential of the business. A pure technical investor does not care about the company's fundamentals. They don't even care if the company is profitable or well-run. The technical investor only cares about the market's sentiment at that moment. While a fundamental investor looks at financial statements, a technical investor would rather look at historic charts that reflect the market's sentiment. Later in this chapter there will be some charts to look at. A technical investor can be a good technical investor and lose money simply because he lacks proper fundamentals. Many day traders eventually lose or go broke because they have poor personal money management fundamentals. The same is true for fundamental investors. Many fundamental investors wonder why they do not make money, or lose money, even though they are investing in good, solid, profitable companies. Many fundamental investors lose, even though they invest with good fundamentals, because they lack the knowledge of technical trading. This reality is why Rich Dad wanted his son and me to be qualified, or sophisticated, investors with both good fundamental skills and good technical skills. Average investor versus sophisticated investor. The average investor barely knows what a financial statement is. The average investor is better off investing for the long term, diversifying their portfolio, investing in mutual funds, and then buying, holding, and praying. The sophisticated investor is someone who has money and understands both fundamental investment techniques as well as technical trading techniques.
Hashtag money in the safe, yeah. Money in the bank, yeah. Money every day, I got money every day, yeah. Money in the safe, yeah. Money in the bank, yeah. Money every day, I got money every day.
Words that help you win in any market. If you want to retire young and retire rich, protecting or insuring your assets from catastrophic loss is vital. The average investor in paper assets never feels secure. That is why the average investor feels that investing is risky and, for them, it is. Because they feel insecure, they entrust their money to a fund manager, or their brother who is a stockbroker, or a financial planner, hoping and praying that this person will protect them from market disasters. The problem is, the average mutual fund manager or stockbroker cannot protect them from a crash, nor can they help them make money in a flat market that is moving sideways. The way to win and protect your assets in any market is to learn and truly understand the vocabulary of the fundamental and technical investor, especially in paper assets. It is easy to do if you will invest a little time. Just as a banker will ask to see your financial statement before giving you a loan, which is fundamental, and require you to have property, title, and mortgage insurance on a real estate investment, which is to ensure the technical or catastrophic risk, you too should require the same of yourself if you want to invest in paper assets. The way you do that is to begin understanding the words of insurance when investing in paper assets. A few of these words are: 1. Trends. 2. Moving averages. 3. Stop orders. 4. Call options. 5. Put options. 6. Straddles or collars. 7. Shorts. The average investor may have heard some of these terms but probably does not understand them or has never used them. Many average investors simply discount these very important words by saying, "It's too risky." Saying something is risky may also be saying, "I'm just too lazy to study the subject." What you must know. If you want to retain your wealth in paper assets, you must know how to insure your paper assets against market crashes. The following is a sampling of what you must know. Again, it begins with words. 1. Trends. Every sophisticated investor must understand trends. There is a saying that all sophisticated investors say, and that is, "The trend is your friend." Please remember and use that saying. So what is a trend? The best way to explain it is by telling you a story. When I was a teenager growing up in Hawaii, most of my friends were training to be big wave surfers. Every winter when the large swells rolled in from the north, we would enter the water to prove our courage and improve our skills. One year, a new student arrived from the mainland. He was a pretty good surfer in the small summer swells. When winter arrived, he ventured into the water thinking nothing had changed except the height of the waves. On his first ride on a large wave, he lost control and wiped out at the bottom of the wave. The huge wave curled over him and we did not see him for a long time. Finally, he popped up some distance from us, coughing and swimming as hard as he could. Those of us who were surfing with him could not believe what we saw. We could not believe he was trying to swim against the current. One of us finally said, "Oh no. I can't believe he's trying to swim against the current. No one is that strong a swimmer. When large waves hit the shore, all that water must find a way back out to sea. It is this movement of water out to sea that causes a rip current. It is like a river of water moving parallel to the beach and then out to sea. For those of us raised in the islands, we know to simply relax and let the current take us out to deeper water. Once the current has dissipated, we know to simply swim or body surf in through a safer channel." This new friend did not know how powerful a rip current could be. Instead of going with the flow, he tried to fight it, became exhausted, and nearly drowned. The same thing happens with new investors. Investment cycles come in waves, as do ocean waves. They also change with the seasons. Surfers learn to respect the change in the power of the waves and water with each change of season. Sophisticated investors do the same thing. That is why sophisticated investors say, "The trend is your friend." Just as experienced surfers learn not to fight the waves or currents, sophisticated investors go with the trends, changing strategies when appropriate, or standing on the sideline if things are too choppy. Average investors continue to buy and hold, buy the dips, or call and ask their brokers, "Is this the bottom?" as they get pounded. 3 basic trends. There are three basic trends that affect paper assets as well as all other investment products. One is an uptrending market, often called a bull market. The second trend is a market heading down, and that is called a bear market. The third trend is a sideways trending market, which is a market that is not going up and not going down. The sophisticated investor uses different strategies for the different trends. The average investor has only one strategy and tries to use it on three different trends. That is why they ultimately lose. The idea of investing for the long term is basically a good idea, but investing for the long term with only one strategy is a loser's way of investing. Even animals are aware that there are changes of seasons. When the first chills of winter arrive with the fall season, most animals know they need to prepare for the change that winter brings. The same is true for sophisticated investors. It is only the average investor who believes the words of their financial advisors: invest for the long term. Buy and hold even though the market goes down. If animals are smart enough to know that things change, why aren't humans? 2. Moving averages. Trends are caused by buyers and sellers. If there are more buyers, then the trend is up. If there are more sellers, then the trend is down. An average investor takes comfort when their financial advisor says to him, "The market has gone up over the last 40 years. The sophisticated investor is not watching a long-term average, but a moving average. Just as a surfer watches the daily rise and fall of the tides, the sophisticated investor watches the ebb and flow of money in and out of the market. The sophisticated investor watches these charts because these charts tell them when to change strategy. Fundamental investors look at financial statements and management teams. A technical investor looks at charts such as the following moving average charts. Bull market. Point 1 is an uptrend. Bear market. Point 2 is a downtrend. Point 3 is a sideways moving trend. How do you know if the trend is changing? Does the market give you signs that it is about to change? The answer is yes. It is not an exact science, but it sure beats guessing, going on hunches, and investing on hot tips. Most of us know that meteorologists can predict a hurricane. Although predicting the weather is not an exact science, nonetheless today we are given ample warning if a large storm is brewing. A technical trader can do almost the same thing. That means, while the average investor is holding and praying the market stays up, the professional investors are selling before the storm hits. There are many signs a technical trader looks for. The following charts show one of the telltale patterns a technical investor watches for. Technical traders call this chart pattern a double top. When technical investors see this pattern, they become cautious and begin to change investment strategies, or get out of the market entirely. If you notice, the price of the stock tumbled down sharply right after a double top. Double top. A similar pattern occurs at the bottom of the market. This pattern is called a double bottom. When technical investors see this pattern emerging, they again change strategies or begin to buy stocks while average investors have given up hope and are selling. Double bottom. There are many different types of patterns that technical investors look for. Nor are these patterns absolutes or guarantees. Yet they do give the sophisticated investor a significant advantage over the average investor who is clueless about these market signals. One big advantage a technical investor has is that they have the time to protect their asset prices with insurance. The average investor sits there fully exposed, uninsured, and unprotected. Millions of investors have their financial future sitting at risk, hoping and praying their financial advisor's advice will protect them from the storms that return on a regular basis to any financial market. Every time I hear the so-called financial experts advising, invest for the long term. Don't panic. Just sit tight. Always remember that the market on average has gone up over the past 40 years, I cringe. When I hear these experts saying such words, I shake my head and feel badly for those millions of people who listen to such experts and entrust their financial future to them. Investing does not have to be risky, if you know what you're doing.
It says, ooh la la, ooh la la, ooh la la, ooh, oh, I can't help you, turn me on so bad. Ooh la la, ooh la la, ooh la la, ooh, I just can't seem to get you off my head. Speech
Tools of the sophisticated investor. The average investor only has two choices once the market changes directions. They can hold and lose, or sell and lose. A sophisticated investor has choices other than buying and losing or selling and losing. The following are some of the mental tools that sophisticated investors use to protect their assets and make money in up and down markets. These are the tools that help them make money and protect their money when the market goes down. 3. Stop orders. A sophisticated investor may call their broker and request a stop order if he or she suspects the price of their stock may go down, especially if the market trend is down. The average investor does nothing. If the price of their stock goes down, they just watch it go down. Not knowing what to do, their buy, hold, and pray strategy turns to a buy, hold, and lose strategy. This is how a stop order works. Let's say your stock is at $50 today, and the charts tell you that the market is trending down. All you have to do is call your broker and put in a stop order at, let's say, $48. If the stock price begins to drop to, let's say, $30 because more sellers have entered the market, your stop order becomes a market order and the stock is sold at $48. Your losses are limited to $2. The average investor would lose $18 and still be clinging to the stock. Although stop orders are often used as insurance by investors, they are not always used by very sophisticated investors. Often the share prices tend to gap on the opening transaction. Sophisticated investors already have the news and have decided whether to sell their shares or cancel the stop limit order. The following are 2 reasons why stop orders might not succeed in a falling or volatile market. The first reason a professional investor might not use a stop order is because the trend is heading down too fast. Sometimes in a rapidly falling market, the stop order can be passed by without being executed. For example, let's say the price of the stock is at $50. Since the trend is down, the investor puts in a stop order at $48. That means if the price drops to $48, the stock is automatically sold. But if the market should drop rapidly, it is possible that the $48 price can be gapped or skipped. That's because so many people are selling that there are no buyers at $48, so the stop is passed or gapped. If the price stops at $40 because a few buyers step forward, the best the investor can do is to hold on at $40 or sell at $40. Their stop was passed over. Another reason a stop may not be used by a professional investor is because they are not certain of the trend of the market. For example, let's say again that the stock is at $50 and a stop is put in at $48. As expected, the stock drops to $47, so the stock is sold at $48. The investor feels relieved until he or she realizes the market has suddenly trended up and the price of their stock is now $65. Not only have they lost $2 a share, they have lost out on a $17 move up. Making a killing or being killed. We have often heard someone say, "I am making a killing in the market." During the dot-com boom and bust, there were many people who went into the mania with the idea of making a killing. Instead, they were the ones that were killed. Many people laugh and chuckle at such mania, saying, "How could people have been so foolish?" What many people do not hear about are the people that did make a killing on the way up and on the way down. A friend of mine made a fortune buying early in the dot-com IPO craze. He made a killing, as they say. He also made a killing on the way down. Just before the top in late 1999, he sold every share of dot-com stock he owned. Then as the top neared, he began selectively shorting, explained below, some of the same dot-com company stocks that made him rich on the way up. 3 of those companies fell so far that they went into bankruptcy. So he made a fortune on the way up, and he made an even bigger fortune on the way down. Why? The reason he made more of a fortune on the way down was because he did not use any of his own money and he has not paid taxes on the money he got from shorting the stocks of companies that went bankrupt. When I asked him why, he said, "I shorted shares at the top, which means I borrowed them. Then the companies went down and went bankrupt. I have yet to pay taxes because there has been no closing transaction, so I owe no tax. All I did was sell shares of stock I did not own or I borrowed, and now I await the time when I can buy them back and return them to the person I borrowed them from. Today, he has nearly $875,000 in money he made by shorting a few stocks, sitting in a tax-free municipal bond fund, collecting tax-free interest from money he received by selling stocks he did not own. He says, "I'm waiting for the opportunity to buy those shares back, but until then, I collect the interest on tax-free capital gains money." If you do not understand this transaction, do not worry. Most people do not. If you would like to understand it better, contact a stockbroker or your accountant and ask them if they can better explain it to you. The point is, if you want to make a killing on the way up, you also need to know how to make a killing on the way down. If you don't, then you are often the one being killed by the people making a killing. There is a lot more to learn about using professional trading tools such as stops. There is also a lot more to investing with these tools than just asking your broker to put in a sell stop or a buy stop, which is a stop in the other direction. Sophisticated investors need to have many more tools than average investors. If they don't, they too will get killed while their peers are making a killing. This unfair advantage that sophisticated investors have is the reason why, when I am asked, "What advice would you give to the average investor?" my answer is, don't be average. I say that because your financial future and your financial security are too important to just be average. A word of caution and warning, this is not a book on technical trading. The above example on a stop is a very simple explanation. A sophisticated investor knows how and when to use a short because there are times when stops work well and times when they do not work at all. Before running out to use any of these technical processes, please read, ask, attend classes, and gain experience before attempting to use any of the techniques I have described and will be describing. The primary reason I list a few of these techniques is to let people who think that investing is risky know that investing does not have to be risky. It is still up to the individual to seek further knowledge if they want to use these techniques. 4. Call options. Another word for options is insurance. Simply put, a call option gives the owner of the option the right to buy shares of stock at a certain price per share over a predetermined period of time. A call option is an insurance policy, protecting the investor from missing out on a sudden increase in the price of a stock. For example, let's say the trends and moving average charts indicate that more buyers are entering the market, so prices are moving up. The investor wants to ensure he or she can buy the stock at a better price in case the stock goes up in value. Let's use as an example a stock with a price of $50 per share today. The investor calls his broker and says he wants to buy a call option to buy 100 shares of stock at $50 per share. He might pay $1 per share for that call option, costing him $100. Each option covers 100 shares. He's protecting himself from a sudden upside move. 3 weeks later, the investor returns from a fishing trip and finds out that the stock has risen to $60 per share. The call option technically allows the investor to buy 100 shares of the stock at $50 per share. He could then, if he chooses, sell the same 100 shares at $60 per share. Otherwise, if the stock had stayed at a market price of $50 per share or below, the option would expire worthless, or as sophisticated investors say, out of the money. In the example of the stock rising to $60 per share, the average investor might then exercise his right to buy 100 shares at $50 per share for $5,000 and simultaneously sell 100 shares for $6,000, realizing a gain of $900, $6,000 less the $5,000 less the $100 cost of the option. On the other hand, a sophisticated investor would just choose to sell his option for $10 per share, or $1,000 for the unit of 100 shares, realizing a gain of $900, $1,000 less the $100 cost of the option. When you examine the transaction, the average investor put up $5,000 to make $900. The sophisticated investor put up $100 to make the same $900 gain. In this oversimplified example, which investor made more money with his money? The answer I would give is, the investor who bought and sold options, or the sophisticated investor. The average investor put up $5,000 to make $900, or an 18% return in a month. The sophisticated investor put up $100 and made $900 in less than a month for a 900% return. Again, this is an oversimplified example, and I strongly recommend you study more, gain some experience, and find a competent stockbroker to assist you through this learning process. This example illustrates why Rich Dad did not want to own much, but instead sought only to control. Options give you control over the buy and sell process. It also illustrates one example on how leverage can be created in paper assets and how leverage can be used with less risk and higher returns if you know what you are doing. In this example, the sophisticated investor only put at risk $1 per option. The average investor put up $50 per share. When you go back to the discussion on the velocity of money, which investor's money is moving faster? Which investor can become richer faster?